Okay, tell me, what have you done? Why you did it? What was the result? And would you do it again?
Okay, firstly, we are Dabs, and in this presentation we will discuss our business strategy. In addition, we will focus on our actions, rationale, results, and whether or not we'd have undertaken certain decisions again. Our strategy is to have an employee-owned business in order to maximise our revenues and to have a highly motivated staff, similar to John Lewis and the cooperative. According to the UK government, evidence shows how employee ownership and engagement can increase workers' well-being and productivity.
We wanted to become market leaders, having the best and biggest company. We felt having part ownership of something amazing is much more valuable than having full equity of something average. This, alongside our employee ownership, was the core basis of our business strategy. We also brought a few of our employees to reinforce the effects of employee ownership.
In quarter 1, on day 5, we sold 147,000 shares to investors to gain startup capital and to invest in marketing capital, PP&E and R&D. This led to a sharp decrease in founders' equity to 44%. However, we now had capital allowing us to invest heavily. We would have sold less shares to investors and at least keep 50% of the equity and invested the money more wisely. On day 7, we issued 10,000 shares to our employees to motivate our staff and increase our market share. Our rationale was to create congruence with the management strategy. This resulted in an increase in market share and more motivated staff. We would do same decision again, but it would have benefited more if investment in marketing and R&D were made earlier. On the second quarter, we decreased R&D expenditures and increased marketing expenditures. This was to increase our market share and our revenues, which caused an increase of 31.3% to our revenues from last quarter. On the third quarter, day 195, we reduced our monthly marketing rate to 15,000. The reason we did this was to reduce expenditures and increase net income, as our expenditures were extremely high and it had an adverse effect on our net income. The result of this action did decrease our expenditure. However, this was overshadowed by a vast decrease in net income, revenues and market share, about 3.5% roughly. We wouldn't have undertaken this action again. After the adverse effects of reducing marketing rate, we decided to increase it up to 30,000 on day 220. We wanted to regain the lost market share and increase our revenues and net income. The result of this action was a sharp increase in market share, revenue and net income. We would have applied the same strategy if we were to do it again. The positive results of increasing marketing rate in the previous quarter to 30,000 led us to increase our marketing rate to 50,000, which we did. We rationalized that results of the previous quarter would be mirrored. The result of this action was an increase in our market share and revenue. However, our daily net income decreased from £493 to £38 due to our increased expenditures. We wouldn't have undertaken this again as the investment did not yield the expected returns.
Hold on guys, according to the numbers, quarter 5 looks really bad. Can somebody explain to me what happened?
Basically, at this stage, we felt our initial strategy of market share dominance and employee ownership was not fully being accomplished through our actions. We felt it necessary to undertake major changes which would reflect our business better.
Firstly, we changed our monthly R&D expenditures to 70,000. Our rationale was to accumulate R&D as our research indicated that in a competitive market, over time we needed to differentiate from our competitors through having a superior product. This led to an increase in market share and revenue. Despite the fact we had an initial decrease in net profit, it was gradually increasing, which reflected our actions as long-term. On day 428, we issued 50,000 shares to employees. Rationale for this was to initially maintain our management strategy of employee ownership. We also felt there was a correlation between employee ownership and market share, as motivated staff would increase business productivity. The results mirrored our rationale and our market share increased. We now had an employee-owned company, which was one of our main strategies. We would have undertaken this same action, however, much earlier.
How did issuing so many shares affect you guys as employees?
I feel more a part of the company.
I feel more motivated. I feel more productive.
Burn rate was changed from 0.8 to 0.52 to ensure production capacity met demand. As you can see from the chart, moderation of burn rate led to a decrease in operation expenditures. In quarter 6, we monitored our long-term investments made in quarter 5 in order to see if our predicted results were being met. We also monitored burn rate to keep production and demand quite close to cut down on added expenditures. In quarter 7, we monitored our long-term investments made in quarter 5 in order to see if our predicted results were being met. We also monitored burn rate to keep production and demand quite close in order to cut down on added expenditures. In quarter 8, after accumulating a great deal of R&D, all expenses were reset to zero except for burn rate capacity. This was reflected in our net income and revenues, which had a rapid boost. Before the game ended, our net income of this quarter was $153,758. In quarter 1, the company was a profit burner. This was initially due to heavy investments in PP&E, marketing and R&D. In quarter 2, it is very clear the company's initial investments in the previous quarter has resulted in a positive return of equity of 22.82%, which is extremely high, as most successful companies have ROE of around 3%. In quarter 3 and 4, the company is still extremely healthy, having successful ROE of 18% to 12%. This indicates a gradual decrease in ROE. This was a direct result of increase in expenditures such as marketing rate, which did not give expected returns on the profit margin. In quarter 5 and 6, the net profit margin in both quarters are negative, which indicates initially the company is in a bad state as our ability to convert sales into profit was evidently poor. However, with insight of running the company, we understand the reason these figures are as they are. We made heavy investments in R&D, which had negative effects on our net income. However, we had enough cash on hand to satisfy the short-term losses whilst our business grew, allowing our revenues to exceed expenditures. This is a key limitation of the three-stage DuPont analysis, as the ratios does not explicitly illustrate an accurate depiction of the company's finances. Due to our heavy investments in quarter 5, our ROE went from negative 20.14% to 8.61% in quarter 7. This is a 28% increase. This shows that the business is growing extremely fast as a result of the savvy investments made in the previous quarter. Quarter 8 was the best quarter we had in our venture. Our return on equity increased from 8.61% to 37.36%. This is a direct result of our heavy long-term investments made in quarter 5. We also lowered marketing and R&D expenditures to zero because investments during this period wouldn't be effective.
To conclude, we felt we stuck by our initial business strategy of market share dominance, which was driven by our heavy investments in R&D. In the first 4 quarters, our return on equity was not what we had anticipated, which resulted in us taking major investments. This caused losses in the short term. However, as you can see from the return on equity line plotted from quarter 6, a very continuous line which demonstrated the success of our long-term investments. We also maintain our strategy of employee ownership as influenced by the success of John Lewis and the cooperative. We felt this would induce motivated and productive employees. Our strategy is mirrored by our actions, and we felt we ran a very successful business. Our company was valued at approximately $6.4 million, which ranked second in the whole competition. We only hoped we had control for more than 2 years in order to fully benefit from our initial long-term investments.